Hey, what's going on, guys? Sean McKay here, and I want to talk today about solo 401ks and making sure that you don't make a huge mistake with your own solo 401k, whether you're looking to start one or you already have a solo 401k currently. So, solo 401ks are phenomenal tools, but we have to be very careful about the way that we operate that type of retirement account. And so, as a quick review, a solo 401k is a retirement account that is meant for someone who is essentially a self-employed individual that does not have any full-time employees other than a spouse that actually works in that business or what is considered a highly compensated employee. And so a highly compensated employee is a technical term defined by the IRS, and it can change from year to year. Usually it's a percentage of compensation in the business or overall salary. And so those are essentially the two carve outs for the solo 401k if you are not the only full-time employee in that business. So the solo 401k is a phenomenal vehicle really over other retirement accounts for a couple of reasons. So the first is it has a really high contribution limit. And again, this changes from year to year, but very high contribution limit. So you can put more money into these accounts each year. The second component, which is really helpful, is that it is the only type of self-directed retirement account where you can actually borrow from the account for any sort of personal use that you deem appropriate. So you can use that if you're temporarily in a tough position financially and you need to have some help paying your bills. You could use that for just any sort of personal expenses you choose to. And so that borrowing feature is really helpful. So that's 50,000 or 50% of the balance, whichever is less. And then also for those of you that are looking to use a retirement account and use leverage, so have the retirement account itself actually borrow money, the solo 401k is a much more tax efficient vehicle to use for borrowing money. So, for example, with IRAs, when IRAs borrow money to buy a rental property, for example, there can be significant tax ramifications when that property is sold if there's still debt on that property. Now, conversely, with a solo 401k, you definitely want to speak with your CPA on structuring, but typically, if you're just simply putting debt on the property at the time of acquisition of the asset, so you're not refinancing the property later on, something like that, many times you're avoiding the tax consequence of what's called UDFI, unrelated debt financed income. All right, so now we got kind of the backstory on the solo 401k, what it is, and some benefits for it. Now we want to make sure that we steer clear of the trouble spots and things that can get you into trouble. And so I kind of alluded to it earlier. The first thing we want to be very careful of, and the mistake that some investors will make, is they will actually make contributions for a spouse that does not work in the business. So let's say that a woman named Jessica has a business of some sort, and her husband, Jeff, has no involvement in that business. It is not a good idea to make contributions on behalf of Jeff to that solo 401k. Jeff should only be making contributions if he actually legitimately works in that business. So you want to make sure, first and foremost, that you do not make contributions for a spouse that is not actually working in that business. That's really important. The next thing we want to look at, and again, this is really kind of a discussion to have with your CPA, but just to add as much value as I can to the discussion, when we're looking at our eligibility for a solo 401k, many times individuals can have a multitude of businesses. So they could have, whatever it may be. It could be a restaurant business. They could have a landscaping business. They could have a real estate development business. They could have all these different things going on. And so they'll say, okay, I have for example, landscaping business that does not have any full-time employees. I'll set up a solo 401k for the landscaping business. And so they don't look at the other parts of their business world in terms of an issue with eligibility. But their restaurant could have multiple full-time employees. Their construction business could have multiple full-time employees. And so that could be really problematic because ultimately employees in other businesses actually disqualify you from having a solo 401k for any of your businesses. So that's, again, something you really want to have a discussion with your CPA, have them help you make that analysis. You want to make sure that amongst all the businesses that you are a owner of, that you do not have full-time employees, again, other than a spouse that works in that business or someone that is considered a highly compensated employee. So hopefully there was some value in there for you today. Please feel free to give us a like, throw some comments in the comments section below. And if you haven't already, please subscribe to the YouTube channel. All right, thanks so much, everyone. Have a great day.